Hi, everybody. Welcome to our weekly webinar. We have a new guest with us today, and we are both broadcasting to you live from, oh my gosh, it has never been so cold ever in the Deep South. So for those of you who've seen all of my crazy posts on the internet, you see that all of my Yankee friends are giving me a hard time because what we call snowpocalypse, y'all just call a Tuesday. But for Charles and I, this is very uncharacteristic weather. In fact, I have seen nothing like it in the entire 40 plus years that I have lived in Mississippi. So I'm also super excited to have somebody on the webinar series who talks like me. I love a Southern accent. To give y'all a little background on Charles, other than he has a fabulous accent and he has a good taste in where he chooses to live, he has spent 31 years in the corporate world in senior positions with some of the leading companies in America. In 1997, he formed his own company. The initial business model was to raise debt and equity over 150 million, or over 150 million has been raised for companies across America. At the present time, or in 2013, engineered-based cost segregation and asset valuation services were added. So at the present time, his focus due to IRS tangible property regulations, tax cuts, Job Acts, and the CARES Act. There have been many successes in assisting clients in receiving an excess of 40 million in depreciation that was used to reduce current taxes. So that is his corporate version. And I'll tell you this. So I met Charles through Dr. Ray Foxworth, who y'all know is my amazing boss and I love so dearly. And we were referred to Charles through our CPA after we bought buildings for businesses, and we felt that we could really benefit from Charles's insight and help in that depreciation. And it was amazing what he was able to do for us. So much, in fact, that Dr. Foxworth wondered why he had never heard of this prior to his CPA introducing him to Charles. And he wanted to make sure that all the other providers in the country knew the benefits if they owned their own buildings a lot earlier in their careers than he did. So without further ado, I present to you the Mr. Charles Waterloo. Welcome to the webinar series. Here you go, Charles. I got your slides up and we're ready when you are.
All right. Well, welcome everybody. Appreciate y'all being here today. And as Christy said, even though I have lived in other parts of the country, we're sitting at about 22 degrees in Jackson. We hadn't been over 32 in 3 or 4 days, and there's no activity outside. So it's beneficial that we're able to do a webinar from our homes today. I wanted to take some time today to share with y'all cost segregation. It is a tax strategy that basically does an in-depth analysis by qualified individuals such as engineers, construction, and taxation professionals for the purpose of identifying the individual business assets and their associated costs that basically take the recovery period in more of a useful life. And as I said before, this is a IRS approved tax strategy. Been around since 1986, lay dormant for a number of years. And initially you had to have a $10 million building to justify the cost. But over that period of time, the 13 methodologies that make up the approved IRS cost segregation study was improved upon and streamlined, and now able to do much smaller buildings and even leasehold improvements down to around $100,000. This is my contact information. Please, at any time, either give me a call or drop me an email. I'll be glad to discuss it further with you or answer any questions that we might not cover today. I'll also mention to please text or hit Christy up with any questions you have during the presentation, because I want to make it informal to you and also informal to be able to discuss any concerns or questions that you might have as we go through this. I work with building owners and businesses that have paid for leasehold improvements throughout the United States and provide an engineered-based cost segregation study. As I said, it's a strategy that I was surprised when I got exposed to it a number of years ago. I had never heard the terminology in all my background of finance in the corporate world. And I had a client tell me that he had saved $100,000 on his taxes. He had some nursing homes in South Mississippi. And when he gave me the terminology cost segregation, I had no idea what he was talking about. In fact, I even called it cash segregation for a while. But once I got and started investigating it, I said, well, there's no opportunities out there for that, because surely everybody has done this if they're paying taxes and own a commercial building. And I have found out that that is not the case at all. And there's a couple of things that have come up that have changed some things over the last few years. And of course, what we've experienced since last March with the COVID outbreak, and a number of the small and mid-sized towns really trying to keep their doors open with businesses. Cost segregation originally was an economic decision and strictly based on saving taxes. But as you'll see as we go through this, some changes have been incorporated into cost segregation that now make it almost a compliance issue to be in line with what the IRS requires of building owners now. Of course, there's a perfect storm going on that you can take advantage of now with some things that have changed. And as those of you that own businesses or have spent money on leasehold improvements, if you're not taking full advantage of this, you're missing out on one of the most valuable tax deductions that you have as a business owner. And, you know, I'll stimulate some questions in your mind that we will cover as we go through this. You know, do you have a strategy on your depreciation? What about your expense and capitalization strategy? You no longer can allow that to be kind of a shoot from the hip type thing, because the IRS has established some regulations in what was called the repair regulations a couple of years ago. The CARES Act most recently has made some real benefits that could benefit you in your tax year 2020 because of some changes it made. And of course, the partial asset disposition election, if you have not made that, then you're really not in compliance with what the IRS requires. And I will talk to you what the difference between cost segregation and what your CPA does for you. And of course, there's also the difference between passive and active real estate investors, and being able to group that building in with your practice. Even though you've got them separated, they can be grouped so that you can be treated as a non-passive investor, so you can take full benefits of what's available to you as a building owner. And basically, cost segregation is the foundation. And as I said earlier, it's been around since 1986. In the beginning, totally an economic thing to accelerate your depreciation, to write off some of your parts of your building quicker. And that's changed over time. First of all, the tax cuts of a few years ago came into place, which then allowed opportunities for an expense decision to decide what can be capitalized and what can be expensed in your business. Also, bonus depreciation came into effect, where after September of 2017, anything that you did in your building or a new building that you bought or either built, anything under 20 years depreciation, you can get 100% write-off immediately on all those items. And that will continue for the next couple of years and then die down. Then the CARES Act came in this past year to help people that are having losses or business not as good in 2020. They changed some things there where now you're able to go back 5 years with your losses from 2020 all the way back to 2015. So if you generate losses in tax year 2020 and you pay taxes over the last 5 years, you can go back and apply those losses to those previous years and get a tax deduction. So in a lot of cases, the first year that you do a cost segregation study, because we're taking so many of the items in your building and depreciating them off almost immediately, in some cases, you could generate a loss and you can carry that back for 5 years. And that had changed with the tax cut where you couldn't carry losses back. You could only carry them forward. And basically, a simple way to look at cost segregation is you've got the hamburger there on the left. It costs you $3.99. You buy it and go on your way. But if you look at it from a cost segregation basis, the 2 beef patties and the sesame seed bun are basically what makes up that hamburger. You could eat that hamburger with the meat and the bread and not add anything to it. So that's exactly what we look at with cost segregation. We take the basic structure of the building that's required to be depreciated 39 years, but we take things, and I'll show you different components that we look at, but looking at this example, the special sauce, lettuce, cheese, pickles, and onions are broken down by the actual cost. So if that was a building, those items could actually be depreciated quicker than the actual hamburger there. So cost segregation, again, as I mentioned, is the process of analyzing and identifying commercial building components that are eligible for accelerated depreciation. It results in a lower income tax. And if you do not do this, if you own a building and you're paying taxes and don't take advantage of cost segregation, you're just loaning the government money. And I don't know that there's many people out there that want to loan the government money. The other key thing to keep in mind, and I'll remind you of this as we go in, when you do a cost segregation study on a building that you've owned prior to 2020, you do not have to go back and amend previous tax returns to the year that you bought the building. There's an IRS approved form that we fill out for your CPA called a 3115, and you're able to take an immediate adjustment for all of those additional depreciation credits that we get for you in buildings that have been owned over a year. And again, the calculations that we do are strictly by the U.S. tax code, and it allows you to cash in today instead of leaving it with the government, as I mentioned, for 39 years and take advantage of the time value of money. And our personal property is segregated from the real property. There's different benchmarks that we use, but normally you can look at anywhere from $40,000 to $80,000 per $1 million of cost savings over the next 5 years in accelerated depreciation. But normally on a typical medical facility, we're able to move about 20% of the cost of that building into smaller components that are depreciated quicker. That also takes into consideration if your practice is in a strip center or a building owned by someone else and you paid for the leasehold improvements, we're able to do a cost segregation study on those leasehold improvements at an amount as low as $100,000. The typical building is depreciated for 39 years, but it's made up of 20 to 25% of components that can be depreciated 5 to 7 years, such as the built-in cabinets in your facility, special electrical or plumbing or mechanical that you might have, decorative items such as wall covering, carpeting, flooring, molding, internal doors, security systems, window treatments and coverings, cabling for your special communications, and any kitchen fixtures or refrigeration equipment that you have. 15-year property looks at things like landscaping, plumbing, paving, fencing, parking lots, signage, sidewalks, and irrigation systems. This is an example here of what we would provide to your CPA once we took your building and had the engineers do the study on it and the accountant studying it and breaking it down into these components. So the building components that you see over here in this building, all of these items are 5-year property. And if the building or you owned it since September of 2017, you could write off 100% of those items in the year that we do the cost segregation study for you. The same thing with the 15-year property that makes up the parking lots and landscaping and those types of things. And then the structure of the building that's required to be depreciated for 39 years are items like the roofing system and air conditioning system, electrical, plumbing, that are not specialized types of plumbing or electrical. As I mentioned before, in 2014, the IRS came out with what they call the tangible property regulations. This is important to you because if you have not taken and established a capitalization or a repair strategy for your building, then you're really out of compliance with what the IRS requires there, because you can no longer make a decision when you make a major change in your building or major repair without using the cost segregation study and the repair regulations to determine what percentage of that you can either capitalize or expense. We find all the time now depreciation runs that we get from CPAs where the building has 2 roofs on it. And as you know, a roof's not going to last 39 years, even though the IRS requires you to depreciate it 39 years, it's only going to last about 10 or 15 years. So 10 or 15 years down the road, when you replace your roof, you don't put that roof on the depreciation run without looking at taking off the old roof. So if you've done a cost segregation study, you replace a roof after 10 years, or anytime really after we do the cost segregation study, the undepreciated value of the original roof that you had on the building you get immediate credit for that undepreciated value. So an example of a roof that you replace after 10 years, it's still got 29 years of depreciation left on your depreciation run. You're able to take an immediate credit for that 29 years, and you don't have 2 roofs on the building. Same thing with air conditioning systems and things like that. This is an example, and this is, again, what is one of the items that we provide to your CPA. Say you come in here and you spend $19,000 on your air conditioning system. We had segregated that system out for a cost of $70,000. So the ratio test that the IRS uses is you can spend 30 to 35% of the cost of that component and expense that $19,000. If you don't have that broken down by units of property, you cannot make the decision of whether or not you can either expense or capitalize that. So we find all the time, even 2 air conditioning systems on a building, because the CPA has capitalized that second system and not taken the first system off, which you're not able to do, of course, if you hadn't segregated those components out. So under the codes based on that, again, you got to have the components broken down so you can run that ratio to determine whether something can be expensed or capitalized, and get money back in your pocket for not only being able to expense things that fall under that ratio that the IRS has established, or get a credit for those items that you replace that is over that ratio. Then when in 2017, when the Tax Act and Jobs Act came around, as I mentioned before, you're able to get 100% bonus depreciation for anything that the IRS says you can depreciate under 20 years. And then the CARES Act changed something, because in that tax cut bill, there was an oversight in what's called the qualified improvement property. That's 39-year property that you have used to renovate an existing building where you have replaced 39-year components with 39-year components. And before the CARES Act changed that, you had to depreciate that 39 years. But the CARES Act came back and changed the qualification improvement property to now 15-year property. So it is eligible for 100% bonus depreciation. This takes into consideration new purchases, new construction, additions, or renovations. The other thing I might mention, even though this has been around since 1986, the establishment of the date is when you buy the building. In other words, if you're buying a 5-year-old building, we do the cost segregation study as if everything started when you bought the building, regardless of what the age is. I've done recently some 100-year-old buildings that someone has bought and renovated, and it's treated as a brand new building, therefore qualifying for all the bonus depreciation that a brand new building would be. And again, the best time to do the cost segregation study is in the year that you do purchase the building. But we can go back to what date you bought the building, do the cost segregation study. You would get catch up on all the 5 and 15-year properties. Say you've owned it for 8 to 10 years. The cost segregation study would be done as if you were buying it today. You get all that depreciation credit immediately on your 2020 tax return, and you do not have to amend the tax return for previous years. As I mentioned before, we do what's called the 3115 for you. So we identify the 5, 7, and 15-year property within the building. The other thing that the CARES Act did, as I mentioned, you're able to carry back losses for 5 years. This was changed with the tax cut bill, where you could only carry 80% of your income as a loss going forward till you use that loss up. The CARES Act, and this is only for tax year 2020, you're able to go back 5 years. So let's use an example of if you've owned the building for 3 years, we can come in and do a cost segregation study that would affect your 2020 tax return. But if it generated a loss for you, then you're able to take that loss back all the way to 2015 and start bringing it forward. So if you paid taxes in 15, 16, 17, 18, or 19, you could get a tax refund by going back and capturing the losses that we generate for you in the either business being off in 2020 in conjunction with doing the cost segregation study for your tax year 2020. And of course, if you don't have anything that you can apply that to in the past, and we generated a loss for you because of the cost segregation study and the additional depreciation, you can carry those losses going forward. And again, the I mentioned before, it changed the qualified improvement property, which was major because we were able to go back and even can go back on, if you'd owned the building for a couple of years and done some remodeling and taken out some 39-year property, we can go back and capture that for you and get 100% bonus depreciation on those items. And they allow us to go back all the way to September the 27th of 2017. So basically, you'll be able to retroactively apply the bonus depreciation for those qualified improvement property. Another major item is the partial asset distribution election, which I mentioned earlier. This is when you come in and do renovations, remodel, or replacement. You're able to get the credit for the undepreciated value of the items that you take out of that building. Again, if you have not done a cost segregation study, there's no way of knowing what value you can put on those items that you take out of the building. And this takes into consideration everything that you take out and throw away in the dumpster, including the cost of the demo and even the cost of the dumpster that you have out beside your building when you're doing that remodeling. This also takes into consideration if you're buying an older building, renovating, and then moving your practice into that. Of course, a lot of people tell me, oh, my CPA has already done that. Well, what we find is, number one, the CPA is not an engineer and does not have the ability to go in as an engineer does and break those components down to the degree that we break them down. So basically what we say is they take the low-hanging fruit. And in most cases, they'll be able to identify, oh, you got a parking lot. Well, that's 15 years. Or you've got special flooring that you put in, and that might be 5 years. Well, that makes up such a small portion of the overall building. I've got major companies that I deal with that deal with major CPAs, and you go in and they've got a $2 billion building and only 5% of it has been depreciated quicker or taken bonus because they weren't able to break down the other $1 million that they then lumped into 39 years. And as I said earlier, all you're doing when that happens is you are loaning money to the government over 39 years instead of taking it today. You know, I sometimes use the example, if tomorrow you saw that your numbers on Powerball came up and won, you know, would you take the $60 million today or would you take it over 20 years? I won't answer that question for you, but in my case, I'd take the $60 million. The other question I get a lot of times is, well, I don't want to trigger an audit. This is throwing up a red flag. That is not the case at all. This is not a gray area of the tax code. It's black and white in the tax code. The engineering firm that I use has completed more than 20,000 studies since 2003. They have never triggered an audit. Been involved in some audits where the client was audited for something else other than the building. If that happens, they send in their engineers and their accounting people to justify the study at no additional cost to you, the client. And at no time over those 20,000 studies has one of these cost segregation studies had to be changed at all. So here's an example. What we do is at no cost or obligation to you, I have the analysts do a predictive analysis for you on your building. It shows you what you can expect to get as a benefit and exactly what the fee is going to be to do the study. In the case of the fee, it's a fixed fee. It's not a contingent fee based on how much we save you. It's strictly based upon the type of building, the complications of doing the study, and the size of the building. This is an example here of the predictive analysis that was done. The client said that he had spent $460,000 on the building, and then we broke down and came up and had him a tax savings of $35,000, and the fee was $3,980. Once the information was gathered to find out exactly what was spent on the building, and the study was done, it actually came back that he'd only spent $440,000 that could qualify as building expense. When we did the study, came up, even though the cost of the building was lower, there was a cost savings of $53,000. In most cases, the predictive analysis is very conservative. I always like to say I like to be a hero after the fact instead of before the fact. So most of the predictive analysis are very, very conservative. We're able to look at all the studies that we've done in the past, and basically that's how we come up with that predictive analysis. So basically, how do you get started? All you need to provide to me is the type of building that you have, the address, the building cost without the land, and the year and the month that you acquired the building. And I have the analyst do the predictive analysis for you. Normally, that would take 3 to 5 days. I come back to you with the fixed fee and what your potential savings would be on that building. If you've owned the building over a year or before tax year 220, then I would need a copy of the depreciation run from your CPA. We take that depreciation run and run the predictive analysis off of that. If you bought the building or either constructed the building in 2020, I would need the cost of the building, as I said, less the land, less the equipment that you put into it, and we do the predictive analysis from that. No cost, no obligation to you, and then you can make a hard decision on economics and filing into compliance with what the IRS requires and having your building broken down in units of property. So basically, that is a real quick rundown of what cost segregation is. I didn't see Christy throw up any questions that anybody had, but do not hesitate to either give me a call at any time. I'm in Mississippi. I've done business all over the country. We don't charge any travel time or any added expenses over and above the fixed fee, regardless of where you are in the country. And I like to use the expression sometimes, I doze, but I don't close. So anytime that's convenient for you, reach out to me either by email or telephone, and I will be glad to answer any questions that you might have. And again, thank you for joining us today.
Thank you so much, Charles. We do have a couple of questions that came in. One is, can cost segregation be used on commercial rental properties?
Yes, it can. I've done a number of commercial buildings for what I call the absent owner. It also can be done for residential condos. Done a number of them on the beach in Florida, where the client owns it and rents it out.
Okay, and Dr. Foxworth wanted to know if you could clarify that renters could use this for expenses they are responsible for in the build out or repair of their offices.
That is correct.
Awesome. So if y'all have any other questions, y'all just let me know. We'll get those answered for you right now. If you are watching the recording, please reach out to Charles at Waterloo at waterloocompany.com or using that telephone number 601-594-2381.
Christy, let me just say one other thing. I don't want to mislead anybody when they talk about commercial buildings. Any commercial building, I of course have done a number of medical facilities, but also car dealers, apartment complexes, warehouses, strip centers. Any type of commercial building can qualify for cost segregation.
Well, thank you so much for that. And y'all will notice that I am decked out today for Fat Tuesday. Just wanted to remind y'all that if you have not already registered, you can still join us tonight for our Mardi Gras party that we're doing virtually. I'll throw up the link here so you can register to attend if you have not. If you did register to attend, just know that I am sending out the usernames and passwords here in about an hour. But we have some amazing vendors who have donated some amazing prizes for everyone. We have a game where you can win $1,000 cash by entering in all the parade names. You can also look to see all of the booth prizes that have been donated from all of the vendors participating tonight. We'll be sending out again an email shortly with your usernames and passwords. So again, you do not want to miss that. Now, if you haven't checked out the upcoming webinars on our webinar series for what's coming up in the coming weeks, we have E&M 2021 guidelines for the chiropractic office. We are going over this one more time with Dr. Mario Fissionary, and then we're going to move on to some other great topics. Where did my G codes go? I've been getting a lot of questions about that, so I've asked my good friend and brother from another mother, Dr. Evan William, to come and talk about that. We're going to talk about occupational medicine for DCs with Dr. James Raker, how to white label your nutrition with Dr. Fabrizio Mancini. And then we're going to chat with Dr. Jody Dinnerman and talk about what wonderful things she's got going on and how she's helping chiropractors all across the country. Let's see. Oh, we have a comment in here that said, I sent 2 of my clients to Charles and they both had $1 million in tax savings and over $300,000 in personal tax savings. That is awesome. What an incredible, a referral. I love that. So thank you so much, Chris, for sharing that with everyone today. Again, if you are watching watching this in a recording, which I know many of you do, just make sure that you reach out to Charles with the information that he did provide in the slides, again, with his phone number and email address. Thank you so much. And we will see y'all next week. Same time, same place. Bye, y'all.